Welcome to your June mortgage rate update. Boy, it has been such a roller coaster since we last did our last update in May. So let's talk about some quick news that has hit the headlines, and then we will show you the markets and what's been affecting them. So initial jobless claims came out yesterday. Now this is for individuals who are filing for unemployment for the first time. The number rose 28,000 to 261,000. So 261,000 people filed for unemployment for the first time last week. Now, continuing jobless claims, so these are people who have already filed for unemployment and are remaining on unemployment, is staying about 1.75 million people. Now, these numbers remain at some of the highest levels that we have seen in quite some time. But it's also showing us pretty clearly that hiring is starting to slow. And people are not, because people are continuing to receive the benefits that they're getting and they're not finding new jobs. Now, we care about these job numbers because everybody's like, why do we care about job numbers? What does that have to do with mortgage rates? But we do care about jobs numbers because they affect mortgage bonds. And we know mortgage bonds affect your mortgage rates. So we know that claims are up. We know the amount of hours that people are working is being cut, and it's showing us that this job market is going to turn. And you see, jobs are a lagging indicator. They lag by about a month. So when this market turns, and we don't exactly know when it's going to be, but when it turns, it's going to actually be a good thing for mortgage rates. Maybe not so much for our economy, but good for mortgage rates. Talking about our economy, Europe. Oh man, Europe. The European Union revised their first quarter gross domestic product, their GDP, to negative 0.1%. And they're expecting a negative number second quarter. So according to the European Union and their definition of a recession, they are expecting that they're already in a recession and it will continue. Again, why do we care if Europe's in a recession? We live in the United States. But recessions tend to be globally synchronized. You see, when one area loses demand, it pulls down everybody else around them. And since our world is so globally connected anymore, it would pull us down with it. Now, onto some good news. CoreLogic reported that home prices rose 1.2% in April, beating the estimates up 0.8%. And we're now up 2% year over year. And CoreLogic is also forecasting a rise in May's home prices of 0.9%. and a rise of 4.6% over the next 12 months. So we're already seeing this. We're seeing multiple offers out there. We're seeing houses go for above asking again. So there is not any type of housing crash going on. Home values are increasing. They're going to continue to increasing. So that's why we're trying to tell people waiting to buy, you're not saving yourself anything because the home values are continuing to go up. Now, what's coming up the rest of this month? We get our consumer price index, CPI. Remember, that measures inflation on a consumer level. That comes out June 13th, and we are expecting that number to be good to help bring inflation down. And when that happens, remember, mortgage rates come down. So it should be a good number. Look out for June 13th for that. Now, the Fed is currently in a black period right now, and it just means they're not allowed to talk to the media, and they do this so many days before the Fed meeting. So the next Fed meeting is June 13th and 14th. And remember, I just said CPI comes out June 13th. And that's one of the indicators that the Fed looks at to decide if they're going to raise the federal funds rate. Remember, the federal funds rate does not affect mortgages, but it does affect your car loans, your student loans, your credit cards, your home equity loans, virtually everything else. So they're going to be in that meeting when that number comes out. So a couple of the Fed members have signaled that they are looking to skip the June meeting and not do a hike. So we'll see what happens if they do that, if they decide to skip, but that's what the market is counting on right now. Now, I do want to make sure you understand that a skip means they are likely to raise the federal funds rate in July because they meet again in mid-July. So we think that they're just skipping it right now, waiting on more economic data to come out. And just remember, this is different than a pause. A pause means that they're stopping raising the Fed rates, and then hopefully they would go back down. But a skip means they're just skipping that meeting. So make sure you understand the difference of those two. And let's bring on the charts because I just want to show you what's going on in the mortgage bonds. This this big green line here, remember green is good. It means it's helping rates. Red is bad. So this green line here, that was May 10th. And if you recall, that was a date that we told you to circle on your calendars because we were expecting lower inflation and we got it, which is, it helped mortgage rates. Now you see this line here, how we went down so much here. That is because there was a lot going on in the market. We were up against the debt ceiling, trying to make sure that was getting passed. And then also, while it might not be out there in the news, there's quite a few banks that are on the watch list. Not anything local to us, but some banks that are having to sell treasuries in order to pay consumers who are coming in to get their deposits. Because remember, your money is sitting in a bank. And if you want to go and pull that money out, the bank has to give it to you. But the bank does not have 100% of the money that consumers have put into that bank. They are allowed to loan like 90% of it back out into other investments. But if too many people come to pull their money out, they don't have enough cash. They are forced to sell treasuries, and they're selling them at a loss right now. So I think the one number I heard was PacWest had to sell like $2 billion in treasuries at a $2 million loss. So things like that are happening, and that's why you saw all this downturn, because there was quite a few banks going through that just a couple weeks ago. And you can see what I mean by a roller coaster. We had a couple good days here, and now we seem to be back and forth. So we'll see what happens. Remember to keep an eye out for June 13th when we get the new CPI report, and expect a good time in mortgage rates then. So mortgage rates will continue to come down. They're going to come down slowly. And remember, it's not going to be a straight line. It is going to be an up and down. You know what? If you're happy with the payment, lock in the rate. Chances are you're going to end up refinancing in the next 12 to 18 months anyway. If you have any questions, please don't hesitate to reach out to us. That's what we're here for. And we'll see you next month.